Hello, and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Booking Holdings, Inc., ticker BKNG. Over the next few minutes, I'll discuss both my valuation of this company and my thoughts on its business quality. First up, this company is in the industry of internet and direct marketing retail. We see this as an $83 billion company. Booking Holdings provides travel and restaurant online reservation and related services worldwide. They operate at Booking.com, which offers online accommodation reservations, rentalcars.com, Priceline, online travel reservations. So they also operate out a kayak brand. So basically, and Open Table. So they have Booking, Priceline, Open Table. This is basically an online interface where it serves as a two-way marketplace where they connect customers with providers of services like restaurants, hotels, rental cars, that sort of thing. This has the appearance of what could be a high-quality business based on that description, but we need to look at the financials. Now, over the last 20 years, we can see that they have 19 years of profitability. The only unprofitable year was 2002, which is about to roll off, which means for 19 years in a row, they have had a profitable business. That's despite 2020, in which travel was basically shut down worldwide, including 2021, where it was still heavily impacted. So that's a very good sign for the quality of this business. Now, what else can we see here? We see you have some 2005 kind of peaked at 35%, and then 2009, 37%, 2011, 38%. Now, there is some cyclicality here with some lows of 9% in 2006, low of 12% in 2017. But I think the period we really care about is this last period from like 2011 to 2019 could be what you could say is a relatively normal. There is some cyclicality here. You can see that there is cyclicality in their business. They dropped in 2010 when there was a little bit of a recession. But overall, return on invested capital has been amazing, has been double digits the entire period from 2007 all the way to 2019 was double digits of 30% up at 2019, 12% at the low in 2017, which is totally fine. 12% is an acceptable number. I don't need it to be 30%. I don't need it to be 20%. If you're a 12% number, that's a really good return on invested capital. So it matters how they drive this. But this decline is concerning. It just means that they were investing a lot in order to drive their growth. Now, last 2 years, I think you have to ignore to some degree because COVID isn't normal. But it does show that there's no clear moat here. It can be shut down. You can be impacted by government action or pandemics or stuff like that. So I would say it's a decent quality business from this, but the normalized time besides COVID, what I would say was definitely a high quality business. So your 10-year median returns, return on invested capital of 20%, return on equity of 30%, all amazing numbers. Now, price to earnings of 160. It's hard to really see that. Instead, you kind of got to look at price to sales. And so on a normalized basis, if you take price to sales of 6.7 and you throw in EBIT of 35%, that means you're kind of on a normalized basis price to earnings of 20. And if we do that, we can really see that if we look at these 2019 earnings and we say if 2019 was normal at $111 per share instead of the current $28 per share, and you compare that to the $2,100 per share price, we said it's about a 20 PE. So it's not cheap, but it's not expensive. At 20 PE, you're paying up for a high quality business, and for most of their history, it's been a high quality business. Last 2 years is an aberration. Now, if they never get back to 2019 levels, if they never get back to 2018 levels, then it is very expensive at this PE of 160. So you need to take that into account. What is normal? Is 2020 normal? Is 2021 normal? Or is 2019 and before normal? My view is that 2019 and before is normal, so I'm going to say this business looks fairly high quality. So if you're enjoying this video so far, please hit that like button. It helps me to grow the show audience and get more views. And if you hit the subscribe button and ring the bell, you'll get notifications as I upload new investing videos each and every week. Now, the next thing I want to care about here is this 10-year CAGR. You have asset growth of 19%, and it's growing much faster than revenue and earnings per share. Now, these numbers are manipulated in a sense because your ending period is 2021, where you're still being impacted by COVID. So it doesn't really tell the full story. You see, most of the time period, they actually have very nice growth on the revenue line. And so it's likely that that revenue is at least growing close to assets, even though the decline in return on invested capital shows that it wasn't matching assets. Now, earnings per share growth in a lot of years has been very, very strong. You have years like 77%, 34%, 9%, 8%, 26%. So you're looking at double-digit EPS growth if you exclude this last two period. And you can see that because in 2012, they had $27 per share, and then they grew basically 4x in a 7-year period. So that's really, really strong EPS growth if you look only to 2017 or 2019. Let's go to the income statement here. And you can see, despite COVID, they had positive operating profit through that entire period. They had positive pre-tax income. They had positive profit even during the worst of COVID, which is a very good sign. You can see that they've been retiring about 20% of their shares over the last decade. That's nice. About a 2% reduction every year. If we go to the balance sheet, basically they have really low PP&E. You have $1 billion in PP&E. Which is just a small percentage of your total asset base. They have $9 billion in debt. So compared to their overall, especially when you pull out this cash, basically the entire business is being funded almost entirely by debt. Because that debt completely offsets all of your PP&E, all of your assets. It's a very asset-light business. There's $23 billion in assets against the income statement in a normal year, which would be, let's say, call it $4.5 billion. So you're taking really strong returns. I like what I'm seeing here. You have this constant retiring of shares. You do have some stock-based compensation that goes from about $100 million to $350 million. But for the most part, it's always reducing each and every year. Overall, I'd say Booking is a really good business. If you think this business can get back to what it was before COVID, then it looks very attractive. The valuation is still a little high, but it's not as high as it looks. And despite the fact that these numbers have come down a little bit of time and there is some cyclicality, I would put Booking on my watch list because they're able to sustain high double-digit returns on invested capital for long periods of time. And even this overstates it because they're carrying a lot of cash, so their real return on invested capital is actually much higher than these numbers look like. If you enjoyed this video, hit that like button. It helps to grow the show audience. Please subscribe so that you can get new videos and notifications as I upload new videos about individual stocks and different investing topics to this channel. Thank you for listening, and until next time, stop paying fees, start building wealth.